We may be at the start of earnings season, but my next guest, Rocco Carriero from Ameriprise, is going to give us his read so far. Welcome, Rocco.
Thank you so much for having me.
All right, so we're at the start of earnings season. I know it's early, but what do you think so far? Good, bad? Tell me.
I think that things are pretty much right in line with what should be expected. You know, the economy is still working its way through a really tough time. Things seem to be anemic still, but I think that things are continuing to move forward. You know, we went through a lot over the past 4 or 5 years, and so you gotta definitely you gotta crawl before you walk.
All right, so corporate profits still look good, but markets are hitting new highs. Do you want to sell in May and get away? Do you really want to have a little bit of peace and quiet this summer with things breaking through new highs?
You know, I think that most investors should be strategy focused. So if somebody's strategy focused and they're saying that, wow, the markets seem to be at a high and they're taking some type of distribution from their portfolio, they may want to rebalance and take some cash and refill some of the buckets that they need to replenish in the cash reserve area.
All right, you like dividend paying stocks. Which sectors in particular?
You know, I like consumer staples. There's a lot of great consumer staple companies that are out there, the everyday brands that we all know. Those dividends continue to go up by 8 to 10% as far as increasing the dividend helps to keep up with inflation, consistent earnings. They have lots of cash on the books, and they seem to, you know, provide some income for people.
And it really is hard to find yield out there. People are finding it in places like REITs and dividend paying stocks. What about high yield?
You know, people need to be careful. They need to be careful specifically in the high yield area. They want to make sure that they're not buying extremely low quality and chasing after yield. Higher yield typically means higher risk. So investors really need to be very cautious as to where they're stepping into in the high yield area.
What about caution over this so-called bond bubble? You have the 10-year yield still below 2%, even though stocks and the economy are growing. So how do you caution people when there are worries about a big bond sell-off?
You know, just like stocks need to be diversified, bonds need to be diversified. So a person really needs to look at the whole gamut of the bond market, looking at bonds that perform differently at different interest rate cycles. So there are certain types of bonds that perform better in higher interest rate environments than lower interest rate environments, or stagnant interest rates environments. So there's not really one cure to the bond market where a person just should own one particular bond asset class.
And then finally, as a private wealth advisor who's based out there in the Hamptons, where a lot of Wall Streeters summer and buy big houses, what's the real estate environment like right now?
You know, it's interesting. I just had an agent in the office yesterday for her review meeting. We were talking about this, and she said she's really starting to see the middle market out there start to work its way back. At the end of last year, a lot of the bigger homes, the $20, $25 million homes, sold in anticipation of a tax increase. But the real estate market seems to be doing okay. You're starting to see new buildings starting to come back. So things look good out in the Hamptons.
All right, thanks a lot.
Thank you so much for having me.
Thank you for watching The Street.